I welcome you all for those who are able to make it to this point. This is where we get into the more dicey stuff. And if you've been playing around, well, this is the time to wake up and get serious because we're going to be going deeper into serious business. And then I would like to say that for the new traders who just started learning Forex with this mentorship, you are so fortunate. Why? Because you are learning the main thing. You are learning good stuff from the start. Because when you start learning something that is wrong or that does not work, or that is not consistent, the moment you find the one that works, you discover that you have a lot of work to do. You have to unlearn whatever you've learned before that is not working or that is not consistent to now learn that which works. And I promise you, you are going to learn a lot. First of all, I want us to understand that the market is not random. The market is controlled by an AI algorithm, and we refer to that as the algo. So there's a way the market moves, there's a way the market operates, and you're going to be learning that in this mentorship. All the concepts you're going to learn in this mentorship are all ICT concepts. I do not own them, and they were not created by me. But I remain grateful to his work, and I truly believe that his concept will set the standard for every average trader in this industry. I would like that you take good use of this opportunity and soak in everything, every single detail. Then another thing I'd like to point out is that this is the moment where you will have to go to the charts and practice. This is where you get your hands dirty because the miracle happens in the chart. I will just show you, I will reveal to you certain concepts. But the work you have to do to ingrain this concept into your mind and obtain this skill set is you going into the chart and finding it yourself. You have to find these things yourself. So as I review these concepts in every lecture and teaching, you have to go to the chart and practice till your reticular system can see it easily to the point where you can't unsee it again. So now today we're going to be going into the smart money concept. We're going to be talking about the components of a trade setup. So now we are all aware that this is where we are. We're in technical analysis. Components of a trade setup. There are two components of a trade setup. We have a framework and a reference point. And then this framework and reference point are further divided into four. We have expansion, consolidation, retracement, and reversal. And then for the reference point, we have order blocks, fair value gaps or liquidity voids, liquidity runs and stop runs, equilibrium. Now, these words may look new to you. In order for you to create a trade setup or to take a trade, there has to be a framework or a context that you would want to see in the chart before you take a trade. So now I'm going to be explaining this framework, and there are only four. There are only four things the market do. It's either the market expands, or it consolidates, retrace, or reverse. Now, before you take a trade, you have to know what the market is doing at that point. Is the market expanding? Is the market consolidating? Is the market retracing? Or is it reversing? So when you get the whole framework of what the market is doing, you can begin to anticipate what next will the market do, which will also help increase your probability of making a profitable trade. The reference point listed here are the order blocks, fair value gap and liquidity voids, liquidity pools and stop runs, and then equilibrium. I'm going to be explaining these whole points together and also explaining how they link up and how they are connected. That is the framework and the reference point. All right. So before I move forward, I have to explain something called IPDA, the Interbank Price Delivery Algorithm. Now, I explained before that there's something called the algo. Price movement is actually created by an algorithm, and there's a way it moves. It has a certain pattern. Now, many people will come up to you with the idea of candlestick pattern, support and resistance, trend lines, and also the use of indicators. And I explained to you before that indicators are only mathematical representation of what the price has already done. So you, depending on indicators to take trades, will only already put you in the losing side. So now there's a manner at which price moves, and it's called the algo. So you understanding how price moves will give you an edge over the market. It enables you to trade like the big boys, that is the smart money. Because what the smart money do is they try to create liquidity. And this liquidity they create is gotten from you and I. That is the retail traders. That is the dumb money. Those people who don't understand how the market moves. Because for them to take trade or for their trades to be viable, they need a huge amount of liquidity in the market. Now, let's say they want to take a buy. They need people that will sell to them. And in order to do that, they manipulate the market in such a way that traders that look at the chart, they will be seeing a sell, seeing that they will want to go into the market and take sells. And as they take in sells, the smart money traders take the reversal to buy because without sellers, they can't execute their orders. Looking at this, there have to be a lot of manipulations in order for the smart money to make money off those people who don't know how the market works. So you now understanding liquidity, understanding how the smart money move, how they manipulate the market, will give you an edge over the market. So what you learn in mentorship is not just how to just get a strategy. You're going to be learning how to read the market. It's a skill set where you become the smart money. Now, many of you who are new to this into trading might not really appreciate this mentorship as much because you are starting with something that is actually real, something that is actually consistent, and something that actually works because this is the market. But for those who have learned other things from different places, and maybe might have taken trades, you realize that when you take a trade and set a stop loss, market hits your stop loss and then go in direction you took the trade. But let's say, for example, you buy, market will come down, take your stop loss, and then goes up. Now, you think that that's a mistake, but all those things are programmed. Although they can't see your stop, but they know how to determine where the stops of other traders are, especially the majority of those people who don't know how the market moves. So I would like us to understand that there's an algorithm. As we continue this mentorship, we're going to see how these traders, this smart money, manipulate the market. So all we have to do is to trade like them. We're not actually them because we're all retail traders. But what we can do is to see their handwritings in the market and then be able to make money like the way they do. All right. All markets start from a consolidation and moves to an expansion as an explosive move. Now I explained that there are four things the market do. Is it that the market is expanding, is retracing, is reversing, or is consolidating? These four things is what the market do. The market does not do any other thing again apart from expanding, retracing, reversing, or consolidating. Now, there's a point where market starts from. It always starts from consolidation. I'm sure we should be aware of what consolidation is. Consolidation is market movement, just moving quietly. And then expansion is this huge move. When you see an impulse move, it's called an expansion. And then when price goes against that move, it's called a retracement. A retracement. And then a reversal is this. Price is going up and then it started going down. This is reversal. When price moved from bullish to bearish, or it started consolidating, expand, then reverse. So we should know the difference. This diagram is showing us the movement of price. Now, once price tries to consolidate, it always expands. Price does not consolidate and reverse or consolidate and retrace. It always expands. Now, from expansion, it either retrace or reverse. And then from retracement, it expands. Price does not retrace and reverse. It only retrace and then expand. So let me give an illustration here. Price consolidates, from consolidation, expansion. Is either price expands, then it moves to retracement, or it expands, then moves to reversal. Good. So from reversal, we get expansion, or from reversal, we get consolidation. So let's say price consolidated, expand, reverse, then consolidated. Very, very easy. So now this is a chart showing everything I just explained. This is a trade framework. When you go into the chart, you are expecting to see four things happening. It's either is consolidating, reversing, expanding, or retracing. So when you know what form it is, it gives you a framework of how to approach the chart or take a trade. So this is what we call reading price. So once price is moving within a range, because from this point to this point, price continued moving inside this range. We can see it here. Price moved down, went up, moved down, went up, moved down. It was moving in this range. So this is what we call consolidation. This is when the market is quiet. And this is when orders are building. When I mean orders are building, buy orders, sell orders are coming to the market and it hasn't taken a direction yet. Then once price moves this way, because it has broken out of this range, there's a range. We all know what a range is from here to here. Let me bring out a pen so I can see it very clearly. From this point to this point, market has been ranging. Okay, so at this point here, market broke out of this range. This is what we call an expansion. But after going up, it was bullish for a while. It expanded and then reversed because why? It was bullish, then it became bearish. So this year is a reversal. So when we see this, we know that price has taken out liquidity because here is liquidity. Now I will explain further. Why is it liquidity? Now there are many people who like to buy when market goes above a certain amount of price. They are called breakout traders. So they are hoping that as price continues to range in this spot, once it breaks out of this point, they believe that buyers are now getting the strength because it's like a contention between buyers and sellers. That's what they believe. And mind you, I have to let you understand that it's not buying and selling that move price. You have to understand that it's not the buying and selling. Many people will say that, but that's not true. It's an algo that control price. They make price move to where they want it to go through obtaining liquidity from those who don't know what they are doing. So they believe that as price continues to consolidate in this range, the moment it breaks out, it signifies that buyers are getting strength. So what happens? They put their buy orders here to buy. But because the liquidity providers know what they are doing, that is the smart money, they want to deceive traders into thinking that it's going to be a buyer. They tend to buy in and increase the price with the algo, causing traders to go into the market. And as they go into the market with their buy orders, they will sell to those buyers. So they have grabbed the liquidity. So you coming in here thinking that buyers are coming in and then you also should buy. What happens? They grab that liquidity to sell. Because if they want to sell and there are no buyers, they can't put in their order because they're coming with large orders. Imagine they want to sell 2 million units. Let me write it better. Imagine they want to sell 2 million units. Let me just put the M here. And then there are only 10,000 units available. They can't sell this amount of units. They need more buyers. So they'll tend to deceive traders into thinking that price is moving up. And then what happens? When more buyers are coming in, what happens? They sell to them, and then these buyers are taken out of the trade. They lose the trade. Another set of people who are also scapegoats to this price movement are those who are selling but have their stop loss here. Now, I can remember that if you are selling and you are taken out of the trade, either by take profit or a stop loss, you'll be doing the reverse of the trade. So if market comes to your stop loss, you will come out of the trade as buying. Do we understand? So what your stop loss will be, the name will be called buy stops. So if you are in a trade, let me clean all this. If you are in a trade at this point, let's say market is going down, you just think that, okay, market came this place, went up, came this place, so probably it should go down. Or probably you started a trade here, and then the trade started going down. So because it was consolidating, you don't want to lose your potential profit you've made. So your stop loss that was here, you then bring it down to this point here. And then as price continues to range, what happens? It takes out your stop loss. Our stop loss is taken, it provides liquidity for the smart money. And then they are able to sell to those buy stop orders and then make profits in the price movement. So I just explain liquidity here. So we can see this is consolidation. This is the best time to enter the market actually, because market is quiet. Because after consolidation, what happens next is expansion. Expansion next. So here we are seeing a reversal and then an expansion. So we know what an expansion is with this diagram. And then after expanding, market did what? Retraced. After retracing, market expanded again. So let me go back to the image. We can see that after consolidation is expansion, and then after expansion, we have reversal. After reversal, we have retracement. After retracement, we have expansion. So let's go back to the image. So we can see this image here. After expansion, we go to retracement. Not retracement, reversal, or reversal, retracement. No. After expansion, it will either reverse, and like what it did in that image, it reversed, or it retraced. So you know what to do when you are entering the trade. So if the market is ranging, consolidating, you then expect an expansion. So that's the time to enter the trade. But most times you don't know what direction the market will expand to. It may expand up or expand down. So you might wait for it to expand up. Now, once it expands up, you wait again for your retracement, because if you retrace, it tends to continue that trend. So let me draw it out. So market is ranging. You don't know where to go. So let's say it expands this way. Now you might have missed this trade. You wait for it to retrace and then expand again. So this might be your own model. But your model will be when market is ranging. I'm going to teach you how to know when market wants to expand from your range. You enter a trade here, and then after expanding, you've made profits. Another one could be when market range and then reverse. Once it reverse, you are able to enter the trade with the smart money because liquidity have been taken below the market, and then buy to make profits. I'm going to be teaching you how to know when price wants to reverse. You're going to get all this in this mentorship. But you never make money when market is consolidating. This is going to avoid trading the market. This is a time to wait and not trade the market. So I'll explain this diagram again. Market was ranging and then took out liquidity. Market did not just move up this way before going down. There was a reason for market to go up this way. For market to reach this point here, it took out buy stops. Buy stops were taken here and buy orders were taken here. So that two people that were affected. Number one were those people who sold. Now, once they sold, they might have kept their stop loss above the market. They want to protect their trade to limit their losses. And smart money knows that. They know that stops are always placed above or below the recent swing highs. This point here, all the swing high, that's where people normally trade that's where people normally place their stops. So now, these people who sold, not that they know that exactly your stop is here, your stop is here. John is trading today. We can see his stop is here. So let's go and take it. No. Generally, traders usually place their stops here. So what they do is they make the market move above recent formed highs, especially after a consolidation, to grab those stops. Now, those people who are selling, number one, and those people who plan to buy, and they are called breakout traders. They believe that once price move above this range, then the buyers are coming into play. In most times, even smart money would also buy. They will buy so that the price will increase. And once they are buying, it will bring in influx of buyers to buy. And as price is going up, they will think the price is increasing. So let's buy more. Let's buy more. And as they continue to buy more, they create more liquidity for the smart money, which will then use that order to sell their own orders. So they need buyers to sell. So what happens as a result of the huge amount of buyers coming in, they're able to. Now, this may actually be a loss for them because they are buying. They have a way of hedging that loss. And I'm going to go deeper. I just hope that we are not confused, because it's like this, it's like they are selling iPhone in the market. So if I order like 2 million of iPhone, what happens? Because of the demand is higher than the supply, the price will increase. So now once it increase, I've actually purchased the iPhone. I've not made any profit yet. So I've actually lost a certain amount of money because that's the money I used to purchase the iPhone. So now, because I now have this amount of iPhone is in my possession, and as a result of the high demand and low supply compared to low supply, the price has increased. I would then sell it to those people who are buying because they want to buy in order to sell and to make profit from their sales. So I will then sell it to them at that expensive price. And because I sell the amount of money, what happens is now huge amount of supply and high demand, which will now reduce the price down as I sell. Okay, so I hope that is not confusing for us. So after price reversed, it expands and then retraced. After retracing, it expands again and then consolidated a little before expanding, as you can see here. So this is the trade framework. Market is either doing any of these four things. Either it is consolidating, reversing, expanding, or retracing. These are the only four things market do, and this simplifies the whole thing. So when you open the chart, you're able to tell, is market expanding now? Is it consolidating? Is it reversing? Or is it retracing? So when you have this whole context, you are able to know what to do, either to wait or to enter the market. Okay. So this is an example showing to us the four things market do. So this is the framework. Market is consolidating. After consolidation, always after consolidation, market expands. Always. So it's also always good that you wait for a consolidation. This is when the market is quiet. Once the market is consolidating and is done consolidating, it will expand. It doesn't just only reverse and then expand, reverse, and expand. No, 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 no. From consolidation, it always expands. After expanding, look at what happened again. Consolidated and then reversed. Why is this a reversal? Because they are stop orders here. Look at how market broke out here and then reversed, tricked buyers thinking that market is buying now, and then took out their buy orders and sold, expanding further, then retraced. After retracing, it consolidated, then expanded again. So look at how price moves. We have to understand this very much. The major thing we should get is that after consolidation comes expansion. And it's not hard for us to see a retracement. Once price retraces, man, because one thing that may be difficult for us is to see a reversal, and that's a manipulation that markets do. But don't worry, during the course, as we move on, we will become smart traders. We'll be able to tell when market is reversing. And what we'll be doing normally, what people do is they buy when market is going up, and then they sell when market is going down. But what you are going to become, but the kind of traders you're going to become, you're going to be buying when the market is going down. That sounds very crazy, right? When the market is going down, that's when you are buying. And when the market is going up, that's when you want to sell. Because why? You know that the price is going down to stop loss orders of traders that don't know how the market functions. So you want to be placing your orders when other traders will be placing their stop loss, because you are now trading like the liquidity providers. You are in sync with liquidity. You are not the liquidity. Instead, you are following the smart money to grab the liquidity of the dumb traders. Okay. So now I said that there are two components of a trade setup. We have the framework and then the reference point. So I'll explain the framework. The framework is consolidation, expansion, reversal, and then retracement. I explained that. But there are also 4 reference points which are paired with this 4 framework. And this is to help refine the trade. They are called reference points. So the first is called order blocks. The second is fair value gap. The third is liquidity pool. And then the fourth, equilibrium. Now, these are words that you've not heard before, I'm sure. But then I'm going to be introducing what these 4 things are. Order block. Another block is the point where banks, institutional traders, and the smart money tend to mitigate their trades. So we can see this up close candle here is the last up close candle. And then market went up, came down, consolidated, and then hit this point here. That is the open of this up close candle. And look at how price reacted. So this here is another block. I'm just introducing it here. It may not be very clear to us, but I have a lecture specifically for explaining another block. So this is the last up close candle at this move. From here, market was ranging, and then it created an order block. So this is an up close candle. Market moved away from it in this consolidation, in this range, and then returned back to it, and then moved. It rallied. Good. So here is another block. I'll explain it again. So here now, what we call this order block is a bearish order block because why? Once price returns back to it, price goes bearish. Okay. Now we pair an order block with an expansion. An expansion usually begins from another block because we can see another block here and then look at how price expanded. Okay. Another thing that I would also like us to understand is that the order block is usually found in the consolidation. Now, with the name order block has to do with orders that the banks, that is the institutional traders, the smart money traders place. This is where their trades are placed. This is where they tend to mitigate the trades they might have taken while going long. Because this candle here represents smart money moving price higher, taking price higher, then buying in the market to raise price higher. And this will cause many traders to think that the price is going up and cause many of them to take in trades to buy and buy and buy. As price continues to go down, they too also buy. So in order for them to come out of this buying, they tend to execute their orders by selling. And as moment price begins to come down, they allow price to go higher. And this movement here will enable them to take out their trades. And once their trades are taken out, they reverse the trade, which was a buy, they reverse it to a sell, which will give it momentum for price to go down lower. I don't know if we understand. So order block is a way institutional traders hedge against risks. So now this buying was like an investment. They bought into price, they bought into the market, and then made market. That's the whole philosophy about this. That is the whole philosophy. Now, I would like to also explain that not all up candles are order blocks. It's not the last up close candles that form the bearish order block or the last down close candle that form the bullish order block. Not all. And I'm going to be giving you the characteristics to be able to tell which is an order block and which is not. But for now, just understand that the last up close candle that is green, whatever color you choose on your trading platform, is another block. Once price moves away from it and returns to it, price tends to react away from it. Now, I just explained order block. Second thing I also want to explain is fair value gap. I'm just going to be introducing it here. A fair value gap is formed by 3 candles. So we can see these 3 candles. We have 1, 2, 3. If you look at it, the middle candle, there's a space between the first candle here, the low of the first candle, to the high of the third candle. This gap between these two places, let me outline it. The gap between these two places is called fair value gap, FVG. So now I'm going to locate another fair value gap for you to see. We can see this candle here. This is 1, 2, 3. There's a gap between this one and this one, in between, from here to here. This is a fair value gap. I'm going to show you another one again. We see that these 3 candles, 1, 2, 3. There's a gap between the low of the first candle and the high of the second candle. This is a fair value gap. I'm still going to show you another one again so that we get to see it. See this 3 candle here. This is 1, 2, 3. There is a gap between the high of this candle and the low of this candle. This is a fair value gap. So these are gaps between that is formed by 3 candles. So I'm going to show you another one again. I can see here I outlined this one. There's a gap between the first candle and the third candle. This is called a fair value gap. Nothing is printed here. Nothing is printed here. Another one we see here again, from here to here, a fair value gap. So it's very easy, very, very easy to identify. Now, I don't want to look at the chart again if there's anyone you can find aside the ones I've just mentioned. There's one more. Very obvious. Okay. We can see from here to here. There's a fair value gap. There's another small one here too. See this gap here? Price went in, came down into the fair value gap. So the fair value gap is usually paired with reversals. Is the reference point for reversals. Now, what do I mean by reference point? It is where price tends to move away from. Do you understand? Now, look at how this other block is paired with an expansion. Look at how price moved away from the other block. Then if you look at a retracement here, price moved away from the fair value gap. After retracing, price moved away from the fair value gap. Let's go back to the previous example so that we'll see something. Now, do you see something here? This from the low of this candle, let me outline it. The low of this candle and then the high of this candle, it formed the fair value gap. Look at how price moved away from the fair value gap. So we usually pair the fair value gap with retracement. And then we pair another block with what? Expansion. Here is a very good example of another block. So this is the last down close candle. Price went up, moved away, expanded away from it. But because it's a reversal, what happened? Price came down again. It didn't last that long. So this here is a bullish order block. An example of a bullish order block, market moved, came down to it, and then expanded. Okay, so it's very simple. Then we pair consolidation with equilibrium. Equilibrium just measures the midpoint in a range from this high to this high. What is the midpoint? Equilibrium. So I'm going to be explaining the significance of these things. And then the last, we pair reversals with liquidity. The reference point for reversal is liquidity. After taking liquidity, market reverse. It reverses. So it is a manipulation done by smart money. They manipulate the market. They tend to make you believe that market is going a certain way and then reverses to the other way. Why is it going a certain way? It wants to pull in liquidity. It wants to pull in the reverse of the order they want to take in. So you don't want to take in a buy order, they tend to pull in sellers so that they can buy from the sellers. They want to put in a sell order, they tend to pull in buyers so that they can sell to them. So it's very simple. Now I'm going to be going over the framework individually, paired with its reference point. So now, the first one is consolidation with the reference point, which is the origin of interest, the equilibrium. Consolidation is the constriction of price in a trending range with the unwillingness to break out yet. So when price is moving in a range, that's consolidation. It reveals the buildup of liquidity above and below the range by the market makers. So they are the ones causing price actually most times to range. Because why? They are building liquidity. What does that mean? It means there are traders actually who are trying to sell when market is ranging, and are traders who are actually trying to buy when the market is ranging. And when they enter a trade, they would actually put their stops above or below. For those who are buying, their stops are below. For those who are selling, their stops, that is the stop loss, are above the market. So that's what it means. So the market makers are building liquidity. It means those people who are in the trade while the market is ranging, they have their stop loss above and below the market. And the market tends to seek liquidity because why? It needs to provide a liquidity for the institutional traders to take their trade and to execute their orders. And this is very important for us to note because when the market is ranging market is not the time to enter the market. It's the time to wait and see what the market wants to do, to tell you what it wants to do. Because after ranging, it wants to expand. And if it expands, you know what direction it wants to go by the expansion. So if it's either expanding to retrace or it's expanding to reverse or expanding to consolidate again to give an opportunity for another expansion in that direction. We anticipate an expansion to occur after this build-up. That's the next thing. So you can become a trader who just wait for an expansion after consolidating. All you're looking for is consolidation. You can be able to tell, okay, now market is consolidating. What I expect is an expansion, nothing else. An expansion is what I expect. So market is not also perfect. What we need to do is to go into the chart and train our eyes to see consolidations. We have to be able to tell, okay, now what is the market doing? Is it expanding? Is it consolidating or reversing or retracing? This is the time to sit on your hands and wait for a displacement away from the consolidation, most preferably the equilibrium price. Now, I explained that equilibrium is paired with consolidation. Market tends to move in the range, and after moving, it tends to expand, especially from the equilibrium. So that's a telltale sign to let you know when market want to expand. Okay. This is the consolidation. Look at the equilibrium. So I wanted to just focus on the equilibrium. Look at how price touched it. Here it bounced. The equilibriums tend to serve like a magnet for price. See how price bounced on it. Bounced here, bounced here, close to buy, then bounced here. Look at how, just note the way price moved around the equilibrium to let you know that price is not just random. There's a way price moves. Forget about this movement. This is a reversal, but forget about it. But look at how price was consolidating very, very close to the equilibrium. This equilibrium is also called fair value. It means it's fair. When they say fair value, this is a fair price. This is the balanced price. It's neither expensive or cheap, neither in the premium nor in discount. It is fair value. So when price sits here for a while, it tends to leave it. It tends to expand. So now the second is expansion. And then the reference point or the origin of interest is the other block. Expansion is simply the quick move of price away from the level of equilibrium, the midpoint of consolidation. It reveals repricing by the market makers. This can point the direction price is most likely to go. So like I said before, you always want to sit on your hands when price is ranging, when it is consolidating. So after consolidating and price moves up, it tells you that price wants to continue going up because only the market makers can make price move. You as a trader cannot just make price move. You can't. You don't have enough money to make price move. You're down to your trading is just a blip in the market. It doesn't do anything. So these people that make price move, they are trading in they're trading in tons and tons of trillions of dollars. That's why they are the market makers. They make market move. Do we understand? So once the price is ranging, we wait for an expansion, a quick move. So if it moves this way, we know that the price wants to reprice higher. So it gives us a clue of where price wants to go. At this point, you now know when to enter the market. You are not just rushing to enter the market. So the other things you're going to pair this with. And one of it that I mentioned is another block. Very soon we'll learn more. But you now know that you don't just enter the market. You enter the market at a specific time. And in our basics, I explained to you that there are trading sessions where market tends to move. So if you see market range in one of the sessions, let's say the Asian session, you would expect that London session will be an expansion. So you want to pair that expansion with an order block, which you will find in the consolidation. And the other block is usually found at the equilibrium because price tends to move away from the equilibrium. I'll show us shortly. Now, consolidation is broken by a displacement. Another block is printed whilst breaking out of the consolidation, which is found near or at the equilibrium of the consolidation. So let's look at an example quickly. Okay, we know from this diagram is just showing you what happens from expansion. There are only three things that could happen after expansion. Either it retrace, consolidate, or reverse. Most times it's expand, retrace, expand again, retrace, or it expands, then consolidate. Expand, then consolidate. It moves like that sometimes. And sometimes it expands and then reverse. That is maybe it's ranging like this. Expand this way, then reverse. This here is the reversal. I hope we got that. So let's move on. So this is just a diagram to just give a picture of what happens. So we see that market is retracing, and then we have buy side liquidity and sell side liquidity. So this sell side liquidity are those buyers who have placed their stop loss here, hoping that price will continue to go up. And then this buy side liquidity represents stop loss of sellers, of those people who hope to see market go down in price. So now at the equilibrium is where you find the order block. It is where you would pair an expansion to. So as the moment that price is expanding, another block is formed. So you might have missed this expansion because it always expands from the equilibrium. So once it expands, you expect that price will retrace to return back to this other block and then move. It actually expands from the equilibrium. And at the equilibrium, you usually pay it. You pay it with what? An order block. So let's move on. So here's a buy example. So market came all this way and then started ranging, and then ranging. Look at the equilibrium. And then what do you see here? Another block. As soon as market broke out. Now, when market breaks out like this, it gives you a clue. It reveals the direction price wants to reprice to. It tells you where the market makers, institutional traders want to take price to. The moment it moves where you know that it's going to be a buy. So what happens? You wait for it to come back down to this other block, which is found at the equilibrium of the range of this consolidation. So once price gets down to this point, what happens? You get ready to buy. So this happens in all time frame. It can happen in a daily time frame, can happen in a weekly time frame, can happen in a monthly, in a 1 hour, 1 minute. This is a 1 hour time frame. So imagine price going down. What happens? You get at this point to buy. So this can also be a daily time frame. You can use it to form or obtain a bias for your trade. You can tell that, okay, this is what happens. Price hits another block this day. You are expecting that the next day will be a bullish day, which is what you see here. And then the next day should also be a bullish day to take what? Liquidity. Now, what will be lying? What do you think will be resting above this high? Stop orders. Buy stops. Because there are people that will be selling, hoping that price will go down, and then place a stop loss here. So market will want to move and grab that liquidity to enable the market to continue going further. So we look at how market moved from this point here. So we pair another block with an expansion. We always pair another block with an expansion. So it is a reference point that gives us a framework to take a trade. I hope we understand. So here's another example again. Now I want us to note this equilibrium. This is when the market is quiet. You don't want to do anything. Now, the moment market moved, and I think what the break of structure is, all these three candle patterns here, they are called structures. They are price structures. They form a structure. So now the moment price moved and broke, because we are only looking at the highs and lows of the range. We don't look at in between, because it can be deceptive. Look at how price broke structure, came down, broke structure. So it's not really, it's either going up or going down. But we take the highest and lowest of the price range. So this is the highest and this is the lowest of the price range using this price structure in that consolidation. Look at how price came, it broke this low, and as it broke the low, another block was formed. So it's not just one candle that forms another block. Consecutive candles, that's the last up close candle. These are the last up close candles. All these candles here form the other block. Look how price broke it, retraced to the other block, and then expanded. So this is a 4-hour, this is a 4-hour time frame, and then it expanded. So more are going to be coming on the other block. So here's another example again. We can see this is now we should be able to tell when price is ranging. So from this high to this low, price was ranging, forming what? Liquidity above and below. Now look at the equilibrium. What was forming the equilibrium? Another block. This is a bullish order block. So these are two consecutive down close candles. So as price was breaking out of this structure, or as price was breaking out of this range, it formed another block. After which market retraced down and then expanded. So we can see. So we always pair. So whenever we see a range like this, whenever we see market consolidating, we look for the other block at the equilibrium and we wait for the range to be broken. After it is broken, we want to see market return back down to the other block, expecting that price would rally after hitting the other block. This is where we tend to take our trades. Retracement. So another framework or context is the retracement, and is usually paired with the fair value gap or liquidity void. Also known as correction, many people call it correction or pullback. So it is the pullback within the price range. So we know what a price range is. Let me use an example. So let's say price move this way, move this way, move this way, move this way, move this way. Here is a price range. This is a price range, and this action here is called consolidation. Price is consolidating in this range from here to here. Do you understand? So let's say price formed a range and then it corrected or it came back down. So it is retracing deep into this range. Or let's say price moved down. So when it is going back up, it's retracing into this range. This is retracing into this range. So this is a price range. So price correction seeks to close up areas that were not efficiently traded, such as fair value gaps and liquidity voids. So it's just like when you are painting the wall. Let's say this is the wall, and then you want to start painting. What do you think will happen? If you paint it like this while going up, you want to go back down to paint what you didn't paint before. So that's how the fair value gap is. Price tend to go back down to where it left gaps. Do you understand? So price correction seeks to close up areas that were not efficiently traded, such as fair value gap and liquidity voids. This area of inefficiencies are paid with price retracement for the continuation of the established trend. So now, when a trend begins, what happens is that market starts from this point, moves past to this point. See, this is another block. After this expansion, you usually see a fair value gap. Price wants to close it up before continuing the established trends. So that's why we pair the retracement with fair value gaps. I hope we get that. So let's see an example here. Look at how market was ranging from this high to this low, forming buy side liquidity and sell side liquidity. And then price moved, retraced. This is what? A fair value gap. Moved, retraced into what? We now know what a fair value gap is because we can see these three candles. This high and this low. This gap, this candle here is providing the gap, produces the gap. Price moved again. Look at how price keep moving from the retracements. So once price moves, that is once it breaks out of this range, after returning back, now you can see that it is paired with both an order block. All these down close candles, they are a bullish order block. I just brought it out so that we note it. Look at it here. Price moved above it and then returned back to this order block, pairing with a fair value gap. This is like two confluences, and then price moved. Price then retraced down to this. This also is another block, but price did not get to it. Price used the fair value gap here. And then after which, price expanded. Price expanded, retraced again to the fair value gap. You see how fair value gap was very useful for price retracement. Here's another example again. And look at how price was ranging. So now I brought this example for a purpose so that we will understand that not all times price will return back to the equilibrium of where it moved or another block. Sometimes it will go and you have opportunity to enter again. So another opportunity you can use is a retracement, which is paired with a fair value gap. But here we cannot, but here what this is called is a liquidity void. This is not a fair value gap. A fair value gap is when there are three candles. But here we can see no candle at all printed. And then look at how price reacted. It closed just at the high of the liquidity void and then continued. So price found resistance at the liquidity void. Now you will be looking at these examples and maybe confused or still not getting it. But I'm going to be leaving an assignment for us that we'll have to go to the chart and find these things for ourselves. Because you need to train your eyes. If you don't train your eyes, you won't be able to know it. You won't be able to see it even before it happens. You won't be able to identify it. So that's what you need to do. All right. So do not worry. I don't think that you are not learning anything. This is just the introduction into this concept. And then what did price? The price came and broke this low. Because why? Liquidity is resting below this low. Those people who will be thinking that this is a buy now, because they may be thinking that, okay, price broke out, and then it wants to start going up. They'll put their stop orders here and expect price to continue going up. But the smart money, they know what they are doing. After rebalancing this liquidity void, price continues downward to take out liquidity. Now, reversal. Its reference point is liquidity pool. Reversal is the sudden flip of price direction from the established current trend. Reversal occur at liquidity pool. So it is the flip, it's sudden flip. You can see before on the examples I've given. That is price moving from bullish to bearish or bearish to bullish quickly. Reversal occurs at liquidity pools. So here is just a picture or a diagram explaining the concept. Now price is ranging, forming liquidity above and below the market. Then after moving, forming an established trend, we're expecting that the trend will continue, but it just took the buy side and then reverse. Then this is one way reversal could occur. Another way reversal could occur is after the range, it expands, then reverse. These are the two ways market reversal occurs. It could either occur by ranging, expanding, forming a trend, then the trend changes. Now, this is also an example of what I explained before, which I called shift in market structure. Market was bullish, they became bearish. So there are telltale signs that can help you know when the market is changing trend. So I'm going to explain that very soon in this mentorship. Another way is after price was ranging, formed liquidity above and below. What happened? It took this buy side liquidity and then came down, take the sell side liquidity. These are the two ways market reversal always occur in the market. So from reversal to expansion and then from reversal to consolidation. That's the market cycle. Here's an example of a reversal. So market was ranging, forming liquidity above and below the market. So price retraced after breaking out of this range into this fair value gap. You can see a fair value gap here. Very easy for us to see now. Then price expanded, then it consolidated. After consolidating, what happens? It reversed. See how it reversed and then broke structure, break of structure. And then price rallied downwards. So we can see here an example of reversal. Let's look at another example again. So here price was consolidating. See how it was hitting the equilibrium. So we have liquidity here. Reversal always moves from where there is liquidity. You don't call, let me draw this here. You don't call this a reversal. Let's say price moved up, came down, moved up, came down, then moved up. You don't call it because there's no liquidity. There's no grab in liquidity here. But if you see something like this, maybe price went up, came down, went up, came down, went up, came down, then went up. Yes, you can call this liquidity grab because why? There was a grab of liquidity at below this low. So price can also move like this. Let me draw it better so that we can see it. So let's say price moved up, came down, moved up, came down, moved up, came down, moved up, then came down, then moved up. Yes, this in price movement here is a grab of liquidity because a trader might have taken a buy order here and then with his stop loss here. So the moment price moves this direction and retrace and then move, he'll move his stop loss here and then comes down. Wow, that one might go enter here and then keep his stop loss here. And then as price retrace, he will move his stop loss. Another one might even enter here with his stop loss here. So as price continues to create those lows, there is potential stop orders here in order to protect their ongoing potential profits. So the moment price breaks this high and then convince traders that price still wants to go higher, it could retrace, grab liquidity, and then continue going up because it needs more liquidity to go up. They are buying, so they need more sellers.